In this part, we are going to run the market equilibrium. What is market or what is equilibrium? The market means hypothetically all the stocks. So for example, the S&P 500 or KOSPI 200. And equilibrium, it means the stock prices are stable and there is no general tendency for people to buy versus to sell. So in the equilibrium, there are two conditions holds. The current market stock price, that is here, right, should be same with its intrinsic value, P0 hat. And one more condition, expected return here must be equal to required return. You already know this equation, right? So in the market equilibrium, the expected total return is the same with the required rate of return. So we can take a hat here. It means expected total return. And then how can we know this RS, the required rate of return? In this chapter, we just give a number. We assume that. But in the next chapter, we will learn some theory. This RS, the required return, are determined by estimating risk and applying the CAPM. The CAPM is researched by Markowitz, Miller, and Sharp. They got Nobel Prize 1990. So how is the market equilibrium established? If the price is below the intrinsic value, let's say this is the price of intrinsic value, but if the price is lower than this, P0, in this case, the current market price of stock is too low and offers of bargain. The buy holders will be greater than sell orders, so price move to intrinsic value. The price will increase. The opposite case, the P0, the current stock price higher than intrinsic value. In that case, people, the investors think that this price is too high, so to sell the stocks, the price goes to intrinsic value. Let me summarize this. P0 means current stock price, and P0 hat means what? Intrinsic value. We also called fair value or fair price or true price. And RS means what? Required rate of return. And RS hat means what? Expected rate of return. So if the current stock price same with intrinsic value, and the second condition is required rate of return the same with expected rate of return, we call it market equilibrium. But if the current stock price is lower than intrinsic value, it means this stock is undervalued. So investor can buy this stock and get some profit. We can also explain using required rate of return and expected rate of return. In this case, they require this amount, but they expect more return in the future. So they get more benefit when this stock holds, right? The case is if the current stock price is higher than intrinsic value, it means this stock is overvalued. So if the investor hold this stock, they should sell because price goes down, right? we can also interpret as this. They require this amount of return, but they can expect less return, right? Rate of return. So they should sell or not buy. Here is example. If a stock's expected return exceeds its required return, it means RS hat is larger than RS, right? This suggests that what? What does it mean? Is this stock overvalued or undervalued? Yeah, undervalued. Because they require this amount, but they can get more expected return. This case, right? So should buy. And then they get more profit. So this stock is probably good to buy, good buy, right? So this is the end of this chapter. Thank you.